Welcome back, focused learners, to another deep dive explainer. Today, we're breaking down an event that has the entire financial world holding its collective breath. You might want to circle June 12, 2026 on your calendars. We're looking at what is widely anticipated to be the largest, most historic initial public offering, or IPO, of our lifetimes. The public listing of Elon Musk's aerospace behemoth, SpaceX. But listen, we aren't just here to talk about rockets today. We're here to deconstruct the staggering financial architecture behind this massive move. $2 trillion. Let that sink in for a second. That is the rumored maximum valuation being floated for SpaceX as it enters the public markets. Just to put that into perspective, that places a single private space and technology company in the exact same atmospheric valuation tier as giants like Apple, Microsoft, or Nvidia. It creates this instant narrative tension, right? How on Earth, or rather off Earth, is such an astronomical number even mathematically justifiable? What are the actual mechanics keeping a valuation like this afloat? Okay, let's dive into this. We're going to break this all down into 5 quick steps. First, the raw IPO numbers. Second, the price to sales multiple. Third, why the market actually accepts this. Fourth, the financial impact of XAI. And fifth, the real risks for investors. Let's get right into it. Starting off with Section 1, the IPO numbers, and how SpaceX is setting some wild new records. To really comprehend what SpaceX is attempting here, we've got to look at the current heavyweight champion of the financial world. Until now, the gold standard for public offerings was set back in 2019 by the oil giant Saudi Aramco. They raised $29.4 billion and achieved an initial valuation of $1.7 trillion. At the time, that was literally considered an unreachable peak. But look at SpaceX's 2026 estimates. They're looking to raise a jaw-dropping $80 billion in a single go, targeting a valuation that could hit $2 trillion. But there is one crucial, glaring difference we need to talk about. Saudi Aramco went public as an absolute machine, generating massive, established, reliable profits from global oil consumption. SpaceX, on the other hand, lacks those traditional established profit metrics. So how exactly does the financial world price a company like this? Which brings us to Section 2, the price to sales multiple, and the tricky business of valuing tech growth. When a company is ultra-technological and reinvests practically everything into future growth rather than posting immediate profits, Wall Street has to use different tools to figure out what it's actually worth. If we can't rely on net profit, we look at revenue, the total money coming in the door. Let's break down this core financial concept, the price-to-sales ratio, with a super simple analogy. Imagine you want to buy a small local shop in your town. The shop sells $50,000 worth of goods a year. That's its revenue. The owner says they'll sell you the entire business for $100,000. Because you're paying double what the shop brings in every year, you are paying a multiple of 2. It's a really straightforward way to gauge if a valuation is fair. Now, let's take that exact same math and apply it to SpaceX, which generated an estimated $18.7 billion in revenue in 2025. And this brilliantly illustrates the sheer anomaly we're dealing with. The average company in the S&P 500 trades at a price-to-sales multiple of about 3x. SpaceX, however, is a totally different story. To reach a $2 trillion valuation on $18.7 billion of revenue, the market is attaching a staggering 107x multiple to the company. Let me repeat that, 107 times its revenue. I mean, in traditional finance, paying that kind of premium is borderline absurd. So let's look at Section 3, why the market accepts this, going way beyond just rocket launches. Why on earth are highly educated, incredibly risk-averse institutional investors willing to digest an extreme valuation multiple of 107x? Well, the answer begins right here. When you think of SpaceX, you probably picture rockets launching into the sky, right? But a massive 70% of SpaceX's revenue doesn't actually come from launching rockets. It comes from Starlink, their satellite internet service. That means SpaceX isn't just an aerospace manufacturer anymore. Fundamentally, it has transformed into a massive global telecommunications company, generating consistent recurring cash flow from subscribers literally all over the planet. It's what financial analysts are calling a Frankenstein business model because it spans multiple high-growth sectors all at once. Yes, they're a global telecom with Starlink. Yes, they're an aerospace company, but they're also a data center landlord. For example, AI companies like Anthropic are reportedly paying $1.25 billion a month just to use the Colossus data center in Memphis. By stitching together telecom, commercial real estate, and space travel, SpaceX is essentially positioning itself as the vital underlying infrastructure for the entire tech and AI industry. And the crazy part? They essentially have a monopoly on how to get that infrastructure up and running. Thanks to their unique ability to reuse rockets, SpaceX has completely disrupted industry costs. If we look at the forecasted satellite launch market from 2026 to 2030, analysts are expecting 10 to 20% compounding growth year over year. Investors are paying that massive 107x premium because they aren't looking at SpaceX's revenue today. They're looking at a rapidly expanding monopoly that they believe is going to absolutely dominate the next decade of space and internet infrastructure. That leads us right into Section 4, the financial impact of XAI, which brings a massive twist to the financial narrative. Now, what's really interesting about this slide is the 2026 merger. Elon Musk merged SpaceX with his artificial intelligence company XAI, drastically changing the financial equation for everyone involved. The hype around AI is massive, sure, but so is the cost. From early 2025 leading up to this IPO, XAI has burned through over $20 billion in research and development. Just to put that in context, that represents roughly 2/3 of SpaceX's entire spending during that period. Furthermore, as we neutrally report from our sources, prominent investors like Michael Burry have publicly accused XAI of holding $5.4 billion in hidden debt. The accusation is that they're essentially acquiring massive shipments of Nvidia AI chips through a shell company to keep the expenses off XAI's official books. Whether that's entirely true or just market speculation, it definitely highlights the staggering amount of capital required to stay competitive in the AI race today. And that, my friends, brings us to the true, immediate motive behind this record-breaking $80 billion capital raise. Elon Musk has had to heavily indebt the company to private funds just to finance this massive AI ambition. Our sources indicate that roughly 2/3 of that $80 billion isn't going to go toward building new rockets or new satellites. It's going to be used to pay off existing third-party debts and creditors. That leaves only about $20 billion for actual new investments. Because of this massive appetite for capital, analysts are already predicting a secondary green shoe stock offering shortly after the IPO to raise even more cash once the stock price stabilizes. Finally, let's look at Section 5, the risks for investors. Time for a quick fiduciary reality check. So the crucial point is, what does all of this mean for any investor actually looking to buy into this historic IPO? We need to strip away the multi-planetary hype for a second and look at the cold, hard fiduciary reality. When you read the S-1, that's the official document SpaceX had to file with the Securities and Exchange Commission to go public, you won't just find Elon Musk's visionary quotes about extending the light of knowledge to the stars. You're going to find this exact legal classification: high-risk investment. The company's own legal filings classify the stock as a highly volatile asset built on a really precarious stack of hypothetical future scenarios. Let's actually walk through that stack of hypothetical scenarios because it's basically a massive domino effect. Step 1. Their new 200-ton Starship rocket has to be finalized and launched reliably. Step 2, once it flies, it absolutely must drastically drop the cost of putting heavy payloads into space. Step 3, with cheap launches, SpaceX plans to build experimental data centers actually in Earth's orbit, using the vacuum of space for unlimited cooling and solar power to solve the energy crisis facing AI down here on Earth. And finally, Step 4, those orbital data centers make XAI financially viable. But here's the massive catch. Domino number 1, the Starship rocket, is still in its testing phases. If Starship encounters major delays, the orbital data centers don't happen. If the data centers don't happen, the AI costs remain unsustainable. The entire $2 trillion valuation hinges completely on a rocket that is still unproven. Which leaves us with this final, critical thought. We've looked at the unprecedented $80 billion raise. We've seen the astonishing 107x price-to-sales multiple. We know all about the immense cash burn of XAI and the heavy reliance on the unperfected Starship. So if this $2 trillion valuation demands paying 107 times the company's revenue for space infrastructure that literally doesn't even exist yet, are everyday investors buying into a solid financial reality, or are we simply funding a visionary's most expensive dream? It's the ultimate high-stakes question for the market to decide on June 12th. Thank you so much for joining me on this explainer. Keep analyzing, keep questioning, and I'll see you in the next deep dive.